How's it going, everybody? It is Dennis, and we're back with another video. And today we're talking about poor man covered calls and how to use this option strategy to beat the markets. Well, possibly beat the markets. Of course, it's hard to beat the markets, but you have a possibility of beating the markets. You have a possibility of creating income while holding long S&P and being able to not only get gains from the S&P, but also gain income on a weekly, monthly, daily, quarterly basis, depending on what kind of risk tolerance you have and what you prefer. But before we even get into all this, I love being transparent. We're going to go ahead and take a look at my holdings and how I trade. As always, I never speak about strategies or ETFs or stocks that I personally don't hold or trade. So this is my spreadsheet. I've been covering it since November of 2024. I've been trading options for 2 to 3 years, but I've been covering the trades for the YouTube channel since November 2024. And these are all the trades I've covered so far. As you can see, I've traded anything from Riot to NVDS to TNA to the S&P to SPXW, which is the index that Robinhood now offers you to trade, and Mara and different stocks of this sort. Currently, TNA and S&P are the only poor man covered call positions that I own. And as you can see, for reference points, for November, I earned $1,949 or $1,949. In December, I earned $920, $1,808 for January, and $1,690 so far should be February. For February of 2025, and I have one more trade left for the S&P, and that's going to boost me up to roughly $1,800 earned for February as well. So I have that. I'm also going to show you guys, these are all the contracts I own. So this is my $540 contract expiring in December of 2024, right at the end of the year, in December 19th. As you guys can see down here, it's currently down 3.77%, but it still has lots and lots of time to go ahead and grow. And it was actually in the positive by $900, but we've recently had a market downturn, so it's to be expected. With that, I have a $615 call paired with it, and I'll explain what this all means in a second. But this is just me demonstrating that I am actively trading this strategy myself. And that call is up 98.17%, and it's earned me $161. I also have TNA contracts, as mentioned. I have a 34 call and a 36 call. I have 4 contracts on 34, which expire in January 16th, are currently down 41.63%. But like mentioned, the market is currently experiencing a downturn. I also have another contract, 6 contracts expiring in July 18th. And those are down 43.99%, but once again, market downturn. On that, I have 10 contracts at 47, up 93.32%, or almost $1,400 earned from those 10 contracts, and that's expiring by March 7th, so in a week from when this video is being recorded, and it's going to be go ahead and move down to next month, where I'll earn another $1,400 on top of that. So what are options what are poor man covered calls? How do I earn income from it? How do I grow it as a portfolio? And how do I experience growth on the S&P and on IWM, which is what TNA trades on, 3 times Russell 2000? How am I able to have growth? How am I able to have income? And how does it all work? Well, I'm trying a new way of explaining subjects, and that is by drawing. I've noticed that when I use this way to explain it to my friends and people around me, it works better. So I thought, why not use this same way to explain for my YouTube channel and for my YouTube videos? So I want to explain this like I explained it to one of my close friends recently, actually, just 2 weeks ago. I'm going to explain how poor man covered call strategies work. So let's go ahead and get started. All right. So we have you want to run the poor man covered call, right? PMCC, poor man covered call strategy, and you want to run it on the S&P because S&P is diverse, it's safe, and it has less volatility than, say, trading on a single stock ETF, right? So you're trading on S&P. The S&P is currently trading at how much? It is currently at 594.54 or 595.92 after market. Right, so currently to buy you 100 shares, we'll say that it costs around $596 as of today to buy yourself 100 shares. Right, so if you want to buy yourself 100 shares, you just multiply by that 100, and that will be $59,600 to go ahead and buy yourself 100 shares of S&P. So there you go. To buy yourself 100 shares of S&P would be $59,600. that is where poor man covered calls come in handy, right? Why would you spend yourself almost $60,000 to own 100 shares of S&P and earn yourself roughly $100 to maybe $200 a week? And roughly, what is that? That's around $400 to $800 a month, but that's a lot of risk you're taking on if you're going for the 200 side. So say you're playing it safe, $400 a month, and you spent yourself $60,000, right? Instead of spending $60,000, you're like, let me run the poor man covered call strategy and not go through this old way of trading, right? Oh, that went really high. Let's not go through this old way of trading, of buying shares and then trading covered calls. What's the point of doing that, right? And plus, not everybody has $60,000 collateral. That's the reason why it's called a poor man covered call. You don't want to go ahead and put up $60,000 in collateral. You don't have the money to put up the $60,000 in collateral. That's where the poor man covered call strategy comes in handy. So how does the poor man covered call strategy work? Well, first things first is we have to look at the delta. What is a delta? Or even before we get into delta, we have to look at the time frame. And with the time frame, we have to look at in what time frame, for what time frame, right? So the time frame we're looking for is for our leaps option. What is a leaps option? A leaps option is an option that expires a year or more further, and you're hoping that the stock that you're trading leaps on is going to go ahead and expire higher than what your price is set at, and you're able to have gains, and you're able to experience the growth on holding that leaps. Leaps are usually 1+ years long, right? You want to have it around 1+ years in time, right? You don't want to have it in 6 months or 3 months. You can if you want, if you're trying to really save on money and you really think you're going to make more than you're going to experience stock growth as well as make more on your calls on the upside. We'll get into that in a second, but leaps, you want to have 1+ year out to be safe. I currently, like I mentioned before, my S&P contract, when I bought it at the time of purchasing it, it was a year plus out from when I purchased it. I purchased it last year in around October time. So I purchased an S&P contract expiring 1+ years, and I started trading on it. Now, before I even purchased it, I also had to look at something special, and we mentioned it just a second ago, and that is delta, right? You have to look at the delta, and you want that delta to be around the 0.70 to the 0.80 mark. What is delta? Well, delta is your chance of profitability when it comes to leaps and general options trading. If you have a 0.70 to 0.80 delta, that is a 70 to 80% chance of winning. Of course, you could go for 90%, but then that will cost you a lot more. We could go ahead and take a look at that in a second. If you take a look at S&P, right? Currently, right here, we're looking at 535. That's an 81 delta. It's a great delta to have, and that's going to cost us 97.68 at market close. But if we take a look at usual price during market open, it's around 95.77, right? But if you want to go ahead and move up to, say, a 90 delta, so let's go ahead and find ourselves a 90 delta. This is a 90 delta. A 90 delta is going to cost you $13,000, $13,880. I say $13,880 because you multiply $138.80 by 100, and therefore it will cost you $13,880. Now, if you want to play it safe, sure, go ahead. This is still roughly 3 to 4 times cheaper than it would for you to purchase 100 shares of S&P. But if you just went for a 75 and 80 delta around the 535 mark, you would buy for 97.68, and that is 6 times cheaper than it would be for you to purchase 100 shares of S&P, and it still holds similar movement and similar safety than a 90 delta does. Of course, 90 delta will be safer. It'll move more than, of course, an 80 delta. And what do you mean by move? Well, I mean move because delta is not only the percent chance of profit and also your safety margin, but it is also the movement of your leap. So what delta means is, say we take 0.70, we multiply it by 100, because when you buy a call, you're owning 100 shares. Let me go ahead and just write that down for you. When you buy a call, right? When you buy a call, you're buying 100 shares, right? You're buying 100 shares when you're buying a call, just letting you know. So every single time you see a number on your options screen, right? So 97.68, multiply that by 100. You see delta, multiply that by 100. You see theta, multiply by 100. We'll get into theta in a second. But a call is always 100 shares. So meaning your delta is multiplied by 100. So you have 0.70 times 100, that's $70 or $80. Why do I say dollars? Because like I mentioned before, delta is also the movement of your option contract. If your option contract or say if the S&P moves up $1, your option contract will move up $70 or $80 if it's at 0.80. If it moves up, so every tick you have in S&P in the dollar mark, you would have a $70, $80 tick on the contract side. Of course, delta also varies depending on how the market moves. If, of course, this S&P goes up, then your delta will increase as well, but we're not going to get into that. That's a little bit more complicated. We're going to keep it simple. But yes, your delta can increase in value for up to the 0.90 mark and 0.99 mark when S&P itself goes up, meaning you experience more growth on the upside and also more safety as well. But besides that, that is the basics of the leap, right? So you want to buy a 1+ year out leap. You want to get a delta around the 0.70 and 0.80. We also talked about theta. What is theta? Theta is also very important. As you can see, it's a negative number for the 535 example we see. So let's take that as an example, right? We have theta. And for example, our theta right now that we're looking at the contract, our example contract is 0.0843. So negative 0.843. What is that? Well, that is the DK, or the minus amount of value. It's pretty much you're losing that amount of value times 100. So like I said all the time, you're holding 100 shares. So 0.0843 times 100. So that's a roughly $8.43 of value you will be losing every single day. And that's not including trading days. On Saturdays and Mondays, it also does count. You will be losing value in your option contract every single day by $8.43. And it will continue to be like that as long as the option is open. Of course, this also changes with movement of the stock, the underlying stock or ETF, as well as the option contract. But if just looking at this example, you'll be losing $8.43 a day on DK by holding this stock option. So, two important Greeks you should be looking at, and that is delta and theta, right? Delta is the most important. That's your percent chance of win, as well as how much ticks you're going up for every dollar the S&P goes up. Theta, it's okay. We're going to get into a second and how to combat theta and just the historical way of combating theta. But let's go ahead and get more into it, right? So we understand what leaps are. Leaps are just the first fundamental part of PMCCs. That is the bottom part of your PMCC. There are also the covered call part of it, right? The covered call part is the important part. This one is your money maker, right? This is your money maker right here, right? The covered call is your money maker. You want to use the covered call to make you weekly, monthly, daily, quarterly income, right? How are we going to go ahead and take a look at the covered call, right? So we're going to go ahead and say we take an example to go do sell call. We'll go ahead and go, for example, we'll go ahead and go to the next Friday, which is how I usually trade. I trade till every single Friday. I do weekly trades. So we'll go ahead and take a look at Friday. And let's go ahead and take a look at a covered call example that I would personally do. I use two different ways of measuring what type of covered call trades I will do, right? For way number one, easiest one, look at the delta. So when you're doing covered calls, your delta will be negative because you're experiencing loss in value the longer you hold a covered call. But you could, if you're trading on Robinhood, you will see they actually give you your chance of profit when you have your covered call. So there's two ways I trade covered calls. That is using the chance of profit. So we have 80% chance, and of course we have 88% chance. And of course I also look at what my, how much income I want to earn on a weekly basis. Maybe I want to earn $100, maybe I want to earn $200. Depends on your risk tolerance. If you want to earn $200 a week, you'll go ahead and go for the 234. That gives you a 79.33% chance of profit. You want to only earn $100 a week, you go for 85 or even 87% chance of winning, and you get $104 or $124 a week, right? And of course, this varies from week to week depending on volatility and movements in the stock. But in general, that's the first way I look at it. That is looking at the chance of profit and how much profit I actually want to make on a weekly basis. The second way of looking at how I'm going to trade on a weekly basis is going ahead and looking at a simple chart like on Yahoo Finance. Anybody has access to this. You go to Yahoo Finance, you go to the S&P chart, you go ahead and click on indicators right here, and you go ahead and enable Bollinger Bands. Bollinger Bands are statistical variations that the stock may experience based on historical movements. And if we go ahead and take a look at that, we can see that the lower Bollinger Band is currently at 593, this white line down here, and the number you see. The middle one is 603, and the top is 614. With that, the stock is currently trading at 594 and 54. So we know that currently the S&P is at its bottom variation. There's either a chance it trends a little bit lower to 593 and maybe dips under the 593 line. As we can see, every time it dips under the 593 line, all the time, statistically speaking, historically speaking, it dips back into the middle and maybe even breaks the middle and goes towards the upper line. I'm not here to read lines. It's not horoscopes. I know a lot of people talk about the lines. What do they mean? The lines, right? I'm not a line reader. I'm not a horoscope guy, okay? I'm not a stock horoscope guy. I just look at statistics and history. So, if we go ahead and take a look, what kind of trade would I do with this? Well, we go ahead and look at the Bollinger Band. If we have, say, a moment like this where the stock, currently S&P was trading at its highs of around 612, 613, and we saw that the Bollinger Band was around the 613, 614 mark, you would have taken trade right there, and you would have got a crazy income of around $200, $300 for that week. And look, it would have dipped, and you would have won that trade. But we're looking right now at the current example. S&P is at 594. The lowering band is 593, middle 603, 614. We take a look back at our S&P contracts. We can see that that 604 trade that we were looking at on the Bollinger Band, the middle one, gives us $269 and gives us 77.12% chance of profit, right? That's looking at this one right here, this line 603.66. So, you could take a risk of 76 or 77.72% chance of profit and make $269. Or you could do what I do myself. I target myself to be around the $100 to $150 mark on my profits when it comes to trading the S&P. So what I would do in this case is I would go a little bit above the 603 mark, and I'll go ahead and take a little bit of a safer trade and go maybe for an 80% trade. 80% chance of profit is what I usually go for. I try not to dip under 80%. Very rarely I'll take it under 80% chance. I said the only time I take it under 80% chance trade is when I do the upper Bollinger Band trade. So say the market is hitting the upper Bollinger Band, I'll take a high risk trade and go below 80% and take that risky trade, because I know that statistically speaking, it is at its highest for that 3-month period, that trading period at the time, right? That's the only time I'll take a risky trade below 80%. But majority of the time, I'll look at see if it's in the bottom. If it's on the bottom section, then I'm gonna go ahead and take a trade at the middle and a little bit of above. And if it's in the middle section, then I'm gonna take the trade of the top Bollinger Band and trade the top Bollinger Band. But in this moment, it's on the bottom, so we're gonna take a middle trade. And the trade that I would take in this moment, for example, would be the 80% profit trade, and that would give me $203 of profit, and this would expire in a week, and I have an 80% chance of winning. Boom. That is it. That is the two ways I trade it. So covered call, 2 ways I trade the covered call. We have, of course, chance of profit or delta, right? So let's go ahead and write that down. Chance of profit or delta. That's a terrible D. Or delta, right? We want it to be at 80%, right? Or if that we're looking at the delta version of it, that would be around negative 23, right? So negative, let's go ahead, negative 23, right? So negative 123 delta or 80% chance of profit is usually what I like to stay above. I don't like to go below 80% unless it's on the top Bollinger Band. So that's the second way of trading, is Bollinger Band. Right, looking at the Bollinger Band, looking at the statistics, right? The Bollinger Band, right? Bollinger Band, we look at the top, right? We look at the midsection, and we look at the bottom, right? We look at these 3 lines to figure out what kind of trades we're doing. And like mentioned before, if it's trading on the top line over here, you want to go ahead and you can take a risky trade if it's trading on the top line. So here, when it's on the top, I'll take an 80% trade. Let's go ahead and move this. I'll take an 80% or lower trade, right? And when it's over here, I'll take an 80% or lower trade. When it's on the midline, right? When it's on the midline, I am not taking an 80% or lower. I am either staying 80% or higher. When it's on the bottom line, right? And this trade is going to be for the midline, when it's trading on the midline, actually, let me connect this better. Let me do it this way. Actually, this will be a smarter way. So when it's trading on the top line, we take top and 80%. When it's trading on the midline, we go ahead and take top line, right? So I want to make this a little bit easier to understand. So when you take when the stock is on the midline, right? Actually, let me explain this better. Let's erase this for a second. I want to explain this better for you guys. Doing this live corrections. So we have top, mid, and bottom. That's the typical Bollinger Band, right? This is statistics, right? Stats, right? But how would we incorporating these profits and deltas with the Bollinger Band, right? So like mentioned before, we have the Bollinger Band right here, right? We have the Bollinger Band. If we have the top line, mid, and bottom. If the stock is here, so let's say, how do we mark the stock? Let's say stock here, right? Stock is here. You trade the top Bollinger Band. So say this is currently, what was the stock at? The stock is currently at 596. Say oh my God, that was a terrible 596 right there. That's 596 right there, 596. Right, so we're gonna take a top trade of 597. That's gonna be our top trade, right? 597. You're taking max risk. If S&P is, say, on the midline over here, I don't know, what would the midline be? Like 570. Say S&P is at 570, right? The trade we will take is, the trade that we'll take for this would be a top one again. So if we're this, we'll take another top trade at 597, right? We'll take another 597 trade. If the S&P is at the bottom line right here and it's trading at 550, right? If it's trading at 550, the trade we're going to take is the midline trade. What is the midline trade going to be? It's going to be 570, right? So that's just how it works. I'm trying to explain this the best I can. I know I was explaining just now in the graph, but that's how it would work, right? So we have, if the stock is at top line, you take the top line trade. If the stock is on midline for the Bollinger Band, you take the top line trade. If the stock is on bottom line, you take the midline trade, right? And of course, with that, you also incorporate your delta. So say your midline trade is 80% below or below 80%, then you don't take the trade. Then you look for something at like maybe 575, which is 80% above, right? Or the delta is 80% chance of profit or above the negative 0.20, right? That's the trade you want to take. If you are at the, let's say, I don't know, if you're at the midline and say the top trade, this 597 trade, this one is an 85% chance of profit, right? Then you could go ahead and if your risk tolerance is, good, then you could go ahead and go down to, I don't know, 592, and that will be at like an 81% chance of hit. Then you'll increase your income, right? So there's many ways to look at it. There's many ways to do it. It's a very, case-to-case basis type thing. I can't give you just one answer that fits all. But in general, if you just follow the Bollinger Bands and you follow the deltas, and you go ahead and know what kind of income you want to earn, if you're setting your income goal, which should be probably a third rule, know your income goal for your trades. If you're trading weekly, know your income goal. If you're trading monthly, know your income goal. So know your income goal. If you want to make $100 a week, right? If you want to make $100 a week, then don't go for the risky trades. Don't take lower than 80% delta, right? If you don't need to, don't take an 80% lower delta. If you want to make $200 a week, then you take higher risk, right? $100 a week is less risk, right? And if you want to take 200 a week, then that is more risk, right? Higher risk, less risk for $100 a week, more risk. The more you want, the more risk you'll have to take, assuming that you're taking the riskier trades, right? So now that we have the basics down of leaps and what type of leaps you want to trade with the deltas and the thetas and the year and the time frame, right? And we know how that works. And we also know how covered calls work. And we know that we want to look at chance of profit and the delta. We want to look at the Bollinger Bands for every ETF and stock you trade. And you want to set an income goal of how much you want to make so you don't overtrade or take too much risk and cause yourself to be caught in a bad situation. There is more to it. So we're going to go ahead and take a look at an example. If you've seen all of this and you still don't understand how poor man covered calls work, or you just don't even understand how the basics are, we could go ahead and take a look at more. So PMCs work this way, right? You have person A, you have person B, and you have person C, right? Person A is the person who has 100 shares, right? This person has 100 shares. Person C wants to bet on 100 shares, or they want 100 shares, right? This is you. You are person B. You are the middleman, right? You are the middleman. And you are going to earn income by taking person A's 100 shares, and you're going to take it and give it to yourself, and you're going to take those 100 shares and then give it to person C, who wants to bet on 100 shares and wants to own 100 shares, right? So you are the middleman. You are the man who's making the money. You are the middleman that makes the money, right? You make the money by taking person A and meeting him with person C, right? And then you pay person A short term, and then you get money from person C at an even shorter term, right? So instead of buying 100 shares and putting up the money, right? I always use the example of, like, imagine you're a cars dealer, right? You're a car dealer, right? So instead of going ahead and purchasing cars straight up from the lot or from companies and selling it to people, you are a used cars dealer, and a person comes to you, is like, hey, I want to sell this car. You go ahead and I need to find someone to sell it to. You go ahead and find a person C, someone to sell the car to. They want to buy the car, and you take that person, you charge them a little bit more. You take his car and then you take person A's car, you buy his car, sell it to person C for a little bit of an upcharge, and make your money and walk out of there with holding no assets, being fully, not having to hold shares, not having to have a loss, and you made the income that you make, and you get out of there, right? You get out of there, you get out of the trade, and you don't have to deal with anything. That's how I always think about it. You are the car dealer. You are the car dealer. Think of it that way. You are the car dealer. You are trading cars, right? You are selling one person's car to another person who wants that car, right? So now that we have all this, we have the theoreticals, right? Or no, we have the full rules you want to kind of follow depending on what your risk tolerance is, right? We have all the rules we know. We know the theory of poor man covered calls and how it works with you being person B and there being a person A and a person C, and you're just the middleman. Let's see an example. So let's go ahead and over here, let's see an example of how we would do this trade, right? So say I am trading the S&P today at the current state. Like we mentioned before, the S&P is at 596s, right? It's at 594 actually. Currently it's trending down even more. But so do say 595, right? S&P is at 595. We made sure to we mentioned before, if you want to buy 100 shares at a 596, well, it's not at 595, but if you want to buy 100 shares at 595, it'll be $59,500. We know that. But let's look at an example of how we would do this. So let's look at our leap. We have to buy our leaps option. Which one would we buy currently as of today on February 26th, 2025? What leap option would we buy? Well, we take a look at the S&P and we go ahead and buy call. We go ahead and go all the way down and say, let's go for March, right? It's already been a little bit into the year, so let's go for March. We scroll our way down and we go down here to 535, and it's at 8102 delta, and it's cost 97.68. Or if we take a look at option profit calculator, which I recommend everybody to use if you're trading options, especially poor man covered call, at market open, it'll be around 95.77. So let's go ahead and go buy. back. So you buy a 535 call. All right, we're buying the 535 call for the market open price of 95.77. Right? You paid 9,577 for you to buy those same, and now you now own 100 shares for until March, right? March what? What was it? March 20th. March 20th, 2026. So you now own 100 shares until March 20th, 2026. You just leveraged yourself compared to the 59,500 that would have cost you to buy. So let's say, let's go ahead and write this out. I'm going to write this out for you guys. 100 shares would equal you 59,500, right? So we take our 95.7, we divide that by 95.77. That's roughly 6x leverage, right? So we just leveraged ourselves 6x, right? Since because it's close to, if we, let's say we round it up to 10, this would be 60, this would be 10, 60 divided by 10 would go ahead and equal 6, right? So we're 6 times leverage roughly. And so we're 6 times leverage. We have 100 shares, and now we could trade covered calls. What type of covered call would I trade? Well, we already went over it, right? If we go ahead and look at the March 7th date, and we go ahead and take a look at that one that we talked about before right here, we would go ahead and make ourselves, for this week, we would make ourselves $203. Let's say my income goal, we're going to play even safer. My income goal is to make around $100 to $150. So I'm going to take a 608 trade. And this is a, 84% chance of winning. So now we do a covered call at 608. Right? Oh. At 608, we would make $147. $147. And this is per week, right? So for a week, actually, let's not do per week because it varies depending on the week. $100 a week, 147. If S&P is below 608, oh, I butchered that 8. Below 608, again, butchered it. 608 by March 7th, 25. Right? So by March 7th, 2025, if the S&P is below 608, you will make $147. Now assume we are able to repeat this on a weekly basis. Let's even tone it down a little bit. Let's say we're able to, on average, right? Let's say on average, we are able to make, right, $120 a week on average. Is $120 a week. If we go ahead and really go at the calculator, not calcium, please calculator. If we take a look at a calculator real quick, 120 a week by 52 weeks, that is $6,240 earned. $6,240 earned in a year, right? So if we're able to average $120 a week, we'll make $6,240 a year. Now, don't forget, a lot of people forget, we have depreciation or we have the loss in value in the leap. So this $535 leap we have will lose value, right? It will lose value due to theta. So we want to outpace theta. You want to outpace theta, and this is where theta comes important. And why you choosing the stock you trade is very important. We want to outpace theta, right? You want to outpace it. How do you outpace it? Well, we go ahead and trade on ETFs and stock that have historical growth, or say you're not trading a ETF like S&P with a long history, then you're trading a single stock. You want to choose a stock that you know, or you have conviction that it is going to go up in the long term. In that 1 year time span, you know that it will go up to a point where it will beat the theta and the decay that you will experience if the stock stays the same value or it drops. But since we're trading the S&P, how much of a percent do we need it to go up to beat the theta? Well, thankfully for us, we have options profit calculator. We have everything already inputted. March 20th, 5:35 call. We need the stock to go up, or the ETF, the S&P ETF, to go up 6.18% from the current price to be break even. We know historically that the S&P, and even ChatGPT could tell you that on a median, the S&P goes up 8% per year. On average, it goes up 10% a year, right? So 8% on median, 10% on average, and I also put the Russell 2000 in there as well because I trade TNA, and that is 7 to 9%. So we know the S&P goes up at a median rate of 8% and on average at 10%. What does that mean for us? Well, that means if it goes a median 8%, our LEAP option will be up $1,323. And if we go ahead and expand this chart a little more, let's go ahead and expand it. If we go up 10%, we'll be up $2,523. So let's go ahead and input that as well. So we have $6,240 a year, assuming we have $120 a week trade. Then we also have our LEAPs, right? That if it goes up 8% of the median, we would be up, where is it? $1,323. $1,323. If it goes up 10% on average, which the S&P does, then we would be up $2,523, right? And that would add into your, yearly income. So the 6,240 on 1,323, that would be roughly, what is that? $7,500-ish, $7,600. If you add the 2,523 into it, then that would be $8,000, almost $9,000 earned from your LEAPs and your covered calls if you're trading weekly, assuming you're earning $120 a week. That is almost 100% return. If you're not including the LEAPs growth, then that's pretty much 60 to 70% return on your investment. And you're 6 times leverage. So if you have $60,000 and you want to buy, instead of buying 100 shares of the S&P, you could hold 600 shares of the S&P by just investing into poor man covered calls and having LEAPs. You can have 6 LEAPs, 6 contracts, and make 6 times the amount of this, right? So that is the PMCC. Now, you might be thinking, it looks so great. If we know the S&P goes up, why doesn't everybody do this? Well, because this doesn't always go up, and you also have to watch your trades, right? So as mentioned before, right here, you would make $147 if it stays below 608. That is when risk comes into play, right? If we are betting on 608, I don't know why I can't draw the 8s. If we're betting on 608, right, we want it to be below 608. We don't want it to be above 608. If it is above 608, you lose money, right? You lose if it's above 608. You don't want to lose, right? You don't want to lose money. We don't want this. We want it to be below 608. That's why we go for deltas of 0.80, right? And we go for a chance of profit of 80%. Because we don't want to lose. We don't want to lose money on the covered calls. You don't want to lose money, right? You don't want to lose it. So you want to stay below the 608 for this example of the trade. So what does this mean? Through these weeks and months and quarters of trading and the year of trading, you need to keep your covered call, right? You need to keep your CC, this right here, you need to keep your covered call above the stock price. You always need to keep it above the stock price. You don't want to dip below, right? You want to keep it above the stock price. So say this is the SPY, it's trending upwards. Your covered call, right? This is the SPY. Your covered call has to be trending up with it, right? You want to be trending up with it, right? You don't want to be right here close to it. You don't want to be close here. You want to be up here. So in case you have movements like this where it goes up, right? You don't want to be caught off guard, right? Let's go ahead and give it a better example, right? Let's go ahead. You want to be like this, and you don't want to be like this. So say this is S&P, all right, SPY. You don't want to be close like this. So in case we have a spike, you're not caught off guard. When you're caught off guard, what happens is you have to move your option upwards. You lose a week or day or month of income because now you have to move your contract upwards, and most of the time it's not going to be a profitable move up, and you might even have to pay to move your shares up. So you could go ahead and leave that position and get another position. You might have to pay a debit. Sometimes you will get a credit, but it will be way lower than you expect it to be, and your income will slow down, and it will be not as efficient as it would be if you just held it above over here at this line. Also, don't forget, there's a chance of being assigned. I've never experienced this in my 2 to 3 years of trading. I've never experienced being assigned for any of my leaps options or covered call options, but there is a risk of assignment. So in this scenario, if S&P is, say, at 610 and your CC, right? So S&P is at 610 and your CC is at 608, and the person you sold that CC to, person C, really wants to buy your contract at 608, right? They really want to buy your contract at 608. They have a right to buy it at 608. And what happens is your leap down here, your leaps option, that's what was that, at 535, you now have to purchase this. You have to purchase the shares at 535. You have to purchase these shares from person A, and then you have to sell them to person C, right? So you have to sell to person C. But here's the issue. If you are not trading this correctly, what could happen is for you to purchase your 535, right? Is to purchase this, you spend $9,577, right? To buy 535, you have to pay another $53,500, right? So we do a quick calculator math for that. We go ahead and do 9577 plus, what was it, 53,500. That is 6,307. If you divide that by 100, what do we get? That is $630 is what SPY should be for you to break even. You need the S&P to be at 630 in case you get assigned for you to break even. So what happens is you're going to be at 608. If you're at 630, you do 630 subtracted by 608, right? And we can do the math really quick. What does that come out to? That comes out to just a minuscule. Actually, I'm sorry, my brain just farted. I was about to tell you what it is, and then I'm not even gonna lie. I looked at the number, and my brain just 22. Okay, I was right. I was right. I was hyping up that moment. I just looked at it and went, what is it again? Let me not embarrass myself. But no, 22. You're losing $22,200 on the trade. You're going to lose $2,200 because you have it set to 608. You need it to be at 630, but you're at 608 because you priced yourself incorrectly. It spiked. You lost, and now the person C wants to go ahead and get their 100 shares. You have to buy it from person A. In total, that'll come out to 630. You're going to sell it for 608, and you just lost $2,200, right? So there are downsides of trading poor man covered calls. You're 6 times leveraged. If the market goes down, you're going to go down hard. I currently am going down on my trades. As you guys saw, if we take a look at the 540, I'm down $332 at 3.77%. The market is only down. Let's look at the past week or the 5 days, right? The market currently is only down. Let's go back really quick to the actual. There you go. The market is down 3%. Oh, no, I don't want to look at the news about NVIDIA, even though NVIDIA's had their thing today. 3% currently down for S&P, and we are down 3.77%. And that's nice. Like, that's not bad. But it could get worse. It could get a lot worse. If the market continues to go down, you will continue to go down faster than the market because you are 6 times leveraged and you do have an option call. So that is all the basics I can really think of that I could draw out for you guys. Now, when it comes to actually trading this, like I said, use things such as, Yahoo Finance or whatever, platform you use. Robinhood also has Bollinger Bands and data such as this that you could use. So use the 50-day moving average, use the 200-day moving average. Great things to have because it can also show you when to purchase. So we take a look at the 1 year right here. We can see that currently it is moving at under the 50-day moving average. A good time to buy the S&P leaps if you have the money to do so, right? Right here down during January 10th was a good time to buy S&P leaps. Over here in August 1st of 2024 was a good time to buy S&P leaps. So anytime is below the 50-day is a great time to buy leaps. If it's below the 200-day, it's an amazing time to buy leaps. But using things for your advantage, if you don't want to purchase anything or you don't use Robinhood, you could go ahead and use Yahoo Finance, Bollinger Band, set it to 20 days, 2 deviation, and you're good to go. It gives you everything you need to do. I used this before I had any other type of charting that I had or paid for. I used Yahoo Finance. It gives you all the data you need. If you're looking to go ahead and purchase leaps and you want to see what the chances of you winning and losing are, of course, you could use your trading where it gives you all that information of here. But you can also look at options profit calculator, which shows you your probability of profit. It is a little bit off as well. I don't know why it's saying 35.8, but we'll still let it say whatever it says. But of course, it also shows you what's the percent you need to break even. You can look at the average and median movement of the S&P, for example, and see how much you would make if it's on median, how much you would make if it's on average. You can theorize, of course, if you have any theories of any stocks of like, hey, I'm going to buy a year out, but I'm going to sell it early. You could check and look how much you would be making at that time frame. But these are all things you can use, very simple things you can use to just trade poor man covered call, right? So just to go really quick over everything that we went over in this video, we went over a lot. Let's go ahead and zoom out, not zoom in. If we go ahead and look out really quick, we can see that what did we go over today? We went over this. We went over that PMCC is a leap and a covered call. With leaps, you want to be 1+ year out. You want to have a delta of 0.70, 0.80. Right here, 0.70, 0.80. You want to have a theta. Well, it doesn't really matter about theta. We talked about it. It's just something you want to pay attention to, right? Most of the time, you're going to be like around 3 to 6 times leverage, depending on what your delta is. But most of the time, it's going to be like 5 to 6 times leverage, right? So currently, it costs $59.6 or $59.5 to buy 100 shares. We're using $9,000 or almost $10,000 to buy 100 shares. You want to remember that the second part of your strategy is covered calls, and that's where that makes your money, either if it's on a daily, weekly, monthly, quarterly basis. I recommend doing either weekly or monthly, depending on your risk tolerance or when you want to make your income. I do weekly, it's just preferable for myself, especially with the S&P and the way it moves. Chance of profit and delta is one you want to look for when it comes to the covered calls. You want to look for that 80% chance of profit. You want to look at the low negative delta. You don't want high negative delta. You want low negative delta. You also want Bollinger Band. You want to look at the Bollinger Band. You want to look at the top, middle, and bottom. That's your statistics. That's where the stock or the ETF should be moving, depending on its historical movement. And of course, with that, we also looked at how you want to be pricing your covered calls depending on the movement. So if the stock is moving on the top line, you want to go ahead and sell at the top line or close to it. That's when you're able to take risks depending on your risk tolerance. Of course, that's when I usually take my higher risk, is when it's trading on the top line. If it's trading on the midline, then if the stock is at the midline price, you want to trade on the top line price. And if the stock is on the bottom line price, you want to trade on the midline price. And if you really want to be safe, you could trade on the top line price, but that is very, very safe of a trade. And I'm not sure if you'll be earning as much income if you were trading there. Now, as mentioned before, you want to set your income goal as well. Do you want to make 100 a week? Do you want to make 200 a week? Do you want to make 300 a week? It all depends on the stock and the ETF you trade. But for S&P wise, I go around from $100 to $150. Sometimes, like I said, if it's on the top side, I can make anywhere from 2 to 3, depending on the situation and how the stock is trading. We looked over how PMCs work and what is the idea and theory of PMCs. You're pretty much a car dealer, right? So you have person A, you are person B, and we have person C, right? So you're person B, you're the car dealer, you're taking person A's car, you're taking the 100 shares, you're going to finding you're someone to sell it to, and that is person C, and you go ahead and sell it to them, right? So you sell the car to person C, they get their car, person A gets rid of their car, and you make your money, and you're out of there. So nothing from you to be put up. We, of course, looked at the example. So 595 currently is what S&P was trading at on 2/26/2025, right? We're showing you that it's 6 times leveraged. We found 535 at 95.77 or 9,577. That was our leap and how much we paid for it, expiring in March 20th, right? We then did a covered call and we earned $147 on it theoretically. And of course, we on average, we would want to make $120 a week. So this would technically be $27 over our average, right? But if we took that $120 average, then we would have made $6,240 a year just on the covered call. We looked over at the fact that if on the leaps, if it kept following the historical evidence that S&P goes up either on median 8% or on average 10%, you would make an additional $1,325 or an additional $2,523 on top of your $6,240, meaning you would either make close to roughly, with the covered call, you'll make around like 70%, maybe 50, 50 to 70%. With the 80%, with the 8%, you would be around 70 to 90-ish. And with the 10%, you would be around like the 90 to 100% return when it comes to your total return on the leaps and the covered calls. We went over all the negatives. Of course, you don't want to be too close to the stock price. That's why we look around the 80%, 85% chance of profit. We look at the average you want to earn. You don't want to get too close and get burnt, right? You want to be above the cover, you want to be below the covered call. You want the stock to be below the covered call price, not above it. Of course, if it is above it, then you could go ahead and roll it over to next week, next month, pay a debit, or maybe take a lower amount of credit, or just close it in total if you decide to do so, and just wait for the market to cool down. The reason is because we mentioned right here, if you're trading close to the S&P, there's a chance that you get caught off guard if the S&P or any stock and ETF you trade decides to bounce up and catches you off guard, right? And in that case, we mentioned right here that you would be down in this example $2,200 because you are priced at $95.77 is how much you put down. You're buying for $535 per share or $53,500. That gives you a cost of $630, which is where S&P should be for you to break even in the case of an early assignment. And in this case, you are at 608, so then you would be down $2,200. So that is options trading. That's poor man covered calls trading. Of course, like mentioned before, these are all the contracts I have. These are all the trades I do. Hopefully this new way of me explaining by drawing and giving demonstrations is understandable and easy to understand. I see it more like a lecture, I guess, in a way. But this is not the only video I'll be doing on poor man covered calls. This is just like a basic video. I know basic, right? It's weird. This is just a basic video of just what's the theory of poor man covered call, right? So person A, person B, person C. What goes into a poor man covered call? So leaps, the covered call itself. Of course, how you want to track it with delta, with chance of profit, with theta, and of course your goals you want to set, and Bollinger Bands and stuff like that, right? Everybody has their own way of tracking stocks, but those are the ways that I use and the ways most people use. And of course, we went over an example and all that source. But in the future videos I'll be providing for you guys, I'll be going down into nit and gritty, going over my own trades and how I traded, and taking a look at specific stocks and ETFs. So for this, we had an example of S&P. In the next video, we'll do an example on stocks themselves. So we'll find some kind of single stock we could trade, and we'll go over an example on that. We'll also do another video maybe on QQQ as well, or even Russell 2000, or maybe the S&P again, but do a more in-depth dive into that. And go over all the trades I do. But in general, that is the poor man covered call strategy. That is how much you're able to earn from it by leveraging yourself 6 times, right? You're leveraging your 6 times to make either 50 to 70%, 70 to 90%, or 90 to 100% returns, depending on market movements. And even when the market dips, you're still going to be earning income, assuming that you're staying above on that rule of 80% profit chance or higher, and you're staying by that rule. And even if the market decides to go back up, you'll be quite in a safe position to move up with the market and recover whenever it decides to recover. So that is the poor man covered call strategy. I hope you guys enjoyed and find it informative. Of course, none of this is financial advice. I would not recommend you to follow any of these trades that I'm showing on the screen. Do your own research, do your own trades, pick your own stocks, pick your own ETFs. But this is just how I trade the poor man covered calls, and how I just do all the things I do, and how I am able to earn the income that I do of $1,900, $920. This was a bad month. See, I'm not afraid to show it. Bad month, December, $920. TNA only got us $580, $580. But here without 1,808, 1,690, right? So there is bad months, there's good months. But if you're trading something like the S&P or the QQQ or the Russell, most of the time you're going to be consistent, and you'll stay consistent, assuming that there's no major movements in the markets. So thank you so much for watching. I will see you guys next video. On Wednesday, we'll be going over the amount we're getting paid for Group C distributions from YieldMax and, of course, Roundhill. And, of course, then also another Friday video coming in next week as well. So keep your eye out for that. Go ahead and like and subscribe if you found this video informative. I'll see you guys in the next video. Till next time, my name's Dennis. See ya.